Hello everybody, James Clemster, Director Investment Management at Momentum Global Investment Management here. My topic today is to talk about global investing post-COVID-19. What I'd like to do at the very outset is just talk about what's been going on over the past quarter or so and the impact on markets and of course portfolios, and then we want to look forward and see where there are opportunities presented by this crisis for long-term investors, and also identify areas we think might be at risk of long-term secular change as a direct consequence of what we've seen. Before we go into that, though, I just wanted to take a moment to reflect and to remind everybody attending this conference that we understand how difficult times like this are for advisors and for their clients. We saw firsthand in the financial crisis and in the aftermath of the financial crisis how difficult it is for investors when they've experienced losses in the order of magnitude that we've seen over recent months. And we understand that if we can be there, help wherever we can, be open, communicative, and assist you in the management of your clients, the management of your business at times like this, it creates very high quality, long-standing relationships. So, as much as this is hopefully a useful session, please only see it as a taster. If you'd like to get in touch more with us, please just speak to your Momentum representative and we will make that happen. Last time in the financial crisis and the aftermath of that, we were able to get on a plane and come and see everybody face to face. And clearly there's no real substitute for that. But this virtual interaction, as much as it is a bit of a compromise, it's actually not too bad in the grand scheme of things. But rest assured, we prefer it. I'm sure you'd prefer it too, that we do this face to face. So the moment we're able to get on a plane and come and see you, we will do that. And so we'll make sure that when we're in town, we'll pop by and see you. One of the questions we get asked a lot is, what should we tell clients? And that's obviously very difficult for us to give you that sort of advice. We're certainly not able to give client advice. But one thing we should always remind ourselves is to look past the lurid headlines at times like this. It's all too easy to get sucked into them and overtaken by their overarching negativity. But what we have to remind ourselves is that we will get through this. The world's finest minds are being applied to it. And we're an ingenious, flexible, adaptive bunch at heart. One thing to remind yourself, in terms of the news flow in particular, is that controversy, bad news sells, whether that be through social media, whether that be more traditional media. The reality is that negative headlines tend to be the ones that attract attention. There's a saying in the press, dog bites man isn't news, man bites dog is. What do we mean by that? Well, very simply, that things that are out of the ordinary are much more likely to get attention than things that are pretty standard. And from an investment perspective, what we've got to remind ourselves is more often than not, markets go up. When markets go down, as we saw in the first quarter of this year, two things happen. Firstly, it's out of the ordinary, so it's much more likely to get a headline. And secondly, clients feel these losses much more acutely than they feel an equivalent gain. And so, that's a terrible confluence of factors which don't help investor sentiment. But what we've got to remind ourselves is, more often than not, even including times like this, markets do go up, and therefore reporting on them going down is understandable because they're out of the ordinary. When it comes to investment markets, generally speaking, no news is good news. Might be worth reminding ourselves that in the last couple of weeks, following the market bottom on the 23rd of March, global markets are up in the order of 20% up. They're up over 20%, which in a normal environment would be thought of as a bull market. Wouldn't get too excited just yet, but it's worth reminding ourselves, because it doesn't get the same sort of headlines as when markets go down. It's a nice little respite for investors, in fact, over this recent period. Another point to remind ourselves, which we've already explored slightly, is the fact that we are behaviourally a little bit suspect when it comes to investing. We become overcome by fear and greed, and as much as these are useful evolutionary tools, they don't necessarily make us particularly good investors. Let's look at the fear side. For example, what it tends to mean is we as as investors with behavioral shortcomings tend to become overcome by negativity at the wrong time. We throw in the towel once all the bad news is in the price. We do it at the bottom of the markets, and while we become more relaxed by taking that emotional strain off the table, it also means we're not able to participate in market recoveries when they happen. And they do happen. To give you an example of this, we've got some great data. We'd be delighted to share it with you. So again, if you want to see it, please do get in touch with your Momentum representative. In the meantime, needless to say, investors that don't participate in those early days of market gains, when markets turn at their inflection point, miss out on very significant long-term returns. And as a result, we do whatever we can to keep investors invested through good times and bad times. The way we do that, just to remind you about our philosophy: firstly, target outcomes that we believe clients need. Secondly, then, make the journey to the outcome as comfortable as we possibly can. And we do that through both protecting the portfolio to downsize wherever we can, but also in terms of managing expectations and being as open and communicative as we possibly can. And those two things combined do the best job we think we can do at keeping clients invested, because in the long term, that's very much the best thing we can do for them. I'm sure one of the topics you and your clients are coming to again and again at the moment is whether now is the right time to be taking money out of South Africa and investing it globally, especially given what the Rand has done over recent weeks. It's an interesting question. It's one we get asked from people all over the world, because we have clients in all 6 of the world's inhabited continents, and one way or another, they all face that decision when thinking about investing globally. We generally take the view that timing currencies is a very difficult game indeed, and more often than not, you can end up on the wrong side of it. What we do know, as a matter of fact, rather than speculation, which is often what currency moves can be, is that whichever economy you are a part of, whether that be South Africa or the UK or the US or a Latin American economy or an Asian economy, it represents a proportion of the world's economy and a proportion of the world's stock market. It may be a big one, it may be a small one. In the case of South Africa, the economy equates to about 0.5% of global GDP, so it's a relatively small economy, despite being a very well-run one and a decent one from an investment perspective, but it is small and limited. And then from an investment perspective, the stock market, you punch above your weight slightly there. The total size of the stock market as a proportion of the global stock market is roughly 1%. So it's a decent stock market. It's not small by any means. There's plenty smaller out there, but if you just stay in South Africa, you're limiting yourself. You're excluding from your opportunity set 99% of the world's stock market. There's dozens, thousands of large cap, very interesting stocks out there. The market's very diversified, so you've got a decent opportunity, not only for returns, but also for risk diversification as well, which if you just stay at home, you're missing out on. So I don't want to give you a view on the Rand particularly. I don't even want to give you a view on South Africa's economy or on the politics. That's something that Sanish will be able to deal with much better than me. But simply in terms of the opportunity set globally, there are so many asset classes, sub-asset classes, sectors, styles, let alone just stocks that you can take advantage of if you think about taking money offshore. Right, that's the introductions out of the way. Let's now turn briefly to reviewing what's been going on over the last 3 months or so. If you rewind back to the start of 2020, investors were looking forward to a year of decent growth and decent returns for shareholders in particular. That was then. The coronavirus crisis has spread like wildfire throughout the world. And to give you some context for that, at the end of February, on 29th of February, there were 85,000 confirmed cases of coronavirus across 58 countries with under 3,000 deaths. Here we are today on the 14th of April, and at last time of looking, there's close to 2 million reported cases across about 200 countries and around 120,000 deaths. So clearly a material impact and a big change in very short order in terms of coronavirus's global impact. It's delivered an economic shock with a speed and severity unprecedented in modern times. And as we move inexorably towards the peak of the crisis, in the developed world at least, the scale of the humanitarian, economic and wealth impact is becoming apparent. Uncertainties and risks remain extremely high. We don't know when the peak will come, nor how long it will take to descend on the other side from the other side from the lockdowns, which are now affecting the vast majority of the world's GDP, but they will be lifted at some point. With no visibility yet on the depth and the duration of those shutdowns, it's impossible to be certain about the ultimate damage to employment and the corporate sector and economies as a result. But plainly, the longer the crisis persists, the greater the long-term damage will be. And what is clear is that the world has been plunged in a matter of days or weeks into a deep recession touching virtually all parts of the economy. Leading indicators published in March and earlier this month in April, they're at all-time lows, and early estimates suggest a sudden combined supply and demand shock will cut GDP by something in the order of 20 to 40% annualized during the lockdown period, which is much higher than anything else in living memory. The speed and the depth of the downturn in the economy and markets in March triggered a major credit and liquidity event. There were severe dollar shortages and cash became king as panic selling and frantic deleverage pushed markets into freefall. And it was only when the Federal Reserve stepped in with a massive support package that the risk of a downward spiral was averted. They effectively committed to unlimited asset purchases, including for the first time corporate bonds, as well as liquidity backing for the huge commercial paper market and money market funds. And with similar support from other big central banks, markets have rallied from the late March lows. This was an important moment in the crisis, a key moment. It removes the risk of a deep recession triggering a systemic financial crisis. And it's important in this context that the vast majority of banks are much better positioned from a capital perspective than they were during the financial crisis. And they're backed up by increasingly large fiscal support packages from governments, many in the range of 15-ish% of GDP, and with the US alone committing trillions of dollars, the risk of the recession turning into a depression has also been averted. Although the indiscriminate sell-off during March brought everything down sharply, it's notable that over the quarter, as lockdowns and recessions took hold, sustainability, balance sheet strength and cash generation have become critical. Quality and growth stocks have substantially outperformed value and small cap stocks, with financials, listed real estate and infrastructure also hit very hard. While uncertainty remains intense, we can be certain of two things. Firstly, a recovery will come, and secondly, that markets have already discounted a great deal of bad news. We can't predict with confidence when the bear market or when this period of market weakness will come to an end, but the extraordinary levels of support provided by central banks and governments will ensure the fabric of economies is largely intact as we exit the crisis. Deeper and longer lasting recessions have therefore been avoided, and the seeds of recovery have been sown. Coming out of this crisis, governments will have spent huge amounts of money and racked up even greater debts to keep businesses going, to keep the economy ticking over, and to save as many lives as possible. We expect a material monetary impulse, perhaps not at the sort of levels we see at the moment on a consistent basis, but the days of low or zero interest rates in the developed world are stretching out as far as the eye can see from here. On the fiscal side, governments are again being very loose and they will do whatever they can to keep businesses, the economy and lives going too. But at some point there has to be a return to some sort of fiscal normality, which will provide a bit of a drag on growth. In recent years, politics has become far more localized, insular, populist than we had become used to over previous decades. And I suppose this crisis does provide a greater risk to globalization. It could be another body blow for the environment that we've been used to over the last couple of decades of integrated supply chains that span the world and go all over the place. Security of supply is undeniably now very important. One of the reasons we can't get things working in a manufacturing sense is because one part of the supply chain is pinched, whether that be here or far away, and it means it's very difficult for the entire supply chain to work. As it stands at the moment, manufacturing supply chains are often 30% reliant on one country, and in the case of computers is actually close to 50%. And I think coming out of this crisis, the chances of businesses and governments being willing to tolerate that sort of security of supply issue is likely to be reassessed. Last couple of days, even French President Emmanuel Macron was making the point that there needs to be more French emphasis in supply chains, whether that be in food or pharma. So it just goes to show how material the changes to supply chains post this crisis may be. The European Union looks likely to face another day of reckoning, with particularly economies like Spain and Italy likely to build debt to GDP ratios well in excess of 150%. They clearly need to do something to address their books, not least because they'd likely fall foul of the European Union's rules. Will this mean a move towards greater federalisation? We've got a monetary union. Do we need a fiscal and a regulatory union in a more meaningful sense, certainly more financial sense across the region? Recently, they've been tentative steps back from issuing European-wide financial instruments. They still remain country by country. But if you don't move close together, then the other risk, of course, comes back on the table as well. There's a greater chance of splintering of the Eurozone group. Clearly, it's an amalgam of economies, disparate economies, that are run very differently, and at some point either I think they need to move close together, or there is a real risk at some point over the next few years that we start to see countries splintering off, whether that be through their own choice or whether that be because they're failing to adhere to the European Union's fiscal rules remains to be seen. It's also quite likely that some industries or sectors are permanently damaged by this crisis. Leisure, travel, tourism are ones that spring to mind, but they may not be on their own. Other areas that might do well out of this, well, I think what we need to remember, of course, is businesses that are strong are likely to be able to weather this storm and come out best placed on the other side. So as much as quality stocks in particular sometimes look a little bit on the expensive side, I think there's real value in having a strong balance sheet today, plenty of cash, low capital intensity, and the ability to grind out outsized profitability as and when money starts coming through the doors again. We'd already been through in the last 5 years a period of very significant disruption post-financial crisis, driven in part by some massive tech names. This might be a catalyst to further put pressure on old school businesses, the old economy, and firms that no longer really operate in a manner that suits our daily habits. Having said that, of course, it's very tempting to write off old businesses and old sectors as being dinosaurs, but there are within that cohort of what we think of as value stocks some really well-run businesses. So again, I think the right thing to do there is identify asset managers in the value market in particular that are very skilled at buying hidden gems and avoiding value traps. And that's where we spend our time working with value managers to complement the growth and the quality businesses we have in the portfolio. Deep-seated and long-lasting changes are on their way with important implications for investors. It's important to remind ourselves that the market will discount both the winners and the losers long before the humanitarian crisis comes to an end. These are the most challenging investment conditions that many, if not all of us, have had to invest through in our careers. It's incredible to think that if you look at us all collectively worldwide, we've never been richer, and we've never had in history the benefit of such incredible technology and healthcare that would be the envy of previous generations. And yet here we are, laid low by a pandemic. More incredible still is the realization that so far the only solution we've found to it is the most basic one imaginable: stay at home. Nevertheless, looking forwards, we've got to remind ourselves that we've got incredible monetary stimulus, near zero interest rates around the world for the foreseeable future, a very strong fiscal impulse, and these two factors, combined with the likely low inflation we've seen for the last 10 years being extended into the future, should be a very good time for risk assets. Perhaps not as extremely good as we saw in the period after the financial crisis, but it's still a supportive environment for equities, credit, other risk-seeking assets, and so we would recommend staying invested in a diversified multi-asset portfolio with a manager that can keep you invested and weather the storm when the going gets tough. Plainly, we don't have all the answers. We don't profess to. No one does. But we believe that investing for an outcome, managing on the downside wherever we can, and keeping clients invested will do the right thing in their best interests, looking forwards through multiple cycles yet to come. Thank you for your support. If you have any further questions, there is a Q&A coming up, but also you can always get in touch with us through your Momentum representative.